We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. Today, we are proud to release a new sponsored episode with Allianz. Our guests are Greg Goin, Regional Vice President, RIA and Institutional Markets at Allianz Life Financial Services, and Mark Paulson, Vice President, Hedge Business Development at Allianz Investment Management. So, Mark, Greg, welcome to the podcast.
Thanks, Bob. Happy to be here.
Thanks for having us.
It's a pleasure to be with you again as well. Now, two things before we get going. For the benefit of our listeners who may not be familiar with you and your work, do you mind just giving us a brief overview? Greg, I'll ask you to go first.
Yeah, of course. So I've been with Allianz for almost 11 years now. Been working with registered investment advisors for the last 4 and have been a member of the Institute since 2018. Did my CIMA in 2019 and have stayed with the Investments and Wealth Institute through the different conferences and subscribed to the magazines and really enjoy the content. And then Mark and I have been working more so over the last 2 years on building out research and a modeling engine that helps advisors deal with challenges in deaccumulation and some of the things that may creep up when it comes to deconstructing portfolios to provide sustainable lifetime income.
Mark?
Yeah, my name is Mark Paulson. I'm the Vice President of Global Hedging within Allianz Investment Management US LLC. It's a wholly owned subsidiary of Allianz Life here in North America. My day-to-day role is really focused on hedging the indexed interest credits that are offered inside Allianz Life, fixed index annuities, registered index-linked annuities, fixed index universal life products, that type of stuff. But what we've realized is I've also, do a lot of work working with Greg and his team around kind of explaining the hedging process and the products to investment committees, to advisor groups. And one of the things we constantly hear when we're out there explaining kind of what the hedging team does and what I do and how our products work is, once an advisor or a group wants to put these types of products into their clients' portfolios, how do they quantify the results of and the impact that one of these products might have in their portfolio? And so what we've been able to do is kind of take and leverage my day-to-day work on the hedging side, this institutional risk management approach, and bring it and put it into this retirement spending plan type analysis that Greg and I want to talk about today.
Great. So as folks will come to learn that you've submitted a paper to the Retirement Management Journal that will be published in December of this year, the title of which is Advising Clients Through the Controllable Factors and Uncontrollable Risks of Retirement of a Retirement Spending Plan. So I'm eager to have you walk us through the paper and the findings.
Yeah, I will start, Mark, and let you speak more towards a lot of the research within the paper. I mean, if we go back a couple of years, Mark and I, when we looked at helping advisors understand the challenges that they're going to face when it comes to deaccumulation, we landed on 4 core tenets of challenges that they have some influence over or can have some sort of control over within recommendations they make to clients. And then we also looked at some of the more difficult challenges that occur when it comes to navigating a 25 or 30-year retirement. And we didn't feel like there was a lot of great tools at the time to be able to assess the efficacy of a portfolio when it comes to deaccumulation and actually look at that with a future or forward-looking approach. A lot of what's been done has been historical. Obviously, having historical context is important, but we live in a very different time with very different market dynamics, low interest rates, maybe persistently low returns when it comes to equities. So we wanted to be able to take what an advisor has today as far as an asset allocation portfolio and see how it stands up over time against things like inflation, their capital market assumptions, and see based on a certain life expectancy, whether that be 85 or 95 or 100, how the portfolio holds up. And then also, 2, how sensitive is that portfolio with just little changes in life expectancy or returns? And so it's taken us over the last couple of years. We've learned a lot in going through this process. It's been quite iterative and have come up with a lot of research in running through scenarios in our engine. And so that's really what the genesis of the white paper was trying to condense everything we've learned down to something that's digestible that leaves people with an understanding of here are risks you'll face that maybe you have some input over, and then here's risks that you have zero control over, and which one of these is more critical that you spend time and attention on with clients.
Mark, anything to add?
Yeah, no, I think Greg kind of hit it on the head. Really we wanted to build a framework to evaluate client outcomes, right? And to quantify the efficacy of retirement spending plan and quantify some of the risks that those retirement spending plan are still exposed to even after you've controlled for the things that you maybe have some control over. So that was really the whole point of this, is kind of somehow put a framework around quantifying the efficacy of a retirement spending plan.
Right. So it's a much needed study. There's very little research in this area around what are the factors that you can control and what are the levers that you can touch to improve outcomes. Talk a little bit about maybe the methodology of the study.
Sure, I can take that one, Greg. Well, we start off with, we wanted this to be kind of agnostic, right? We built this so that all the assumptions that go into our report engine are customizable. So you have to start with a set of capital market assumptions. So a view on how the market's going to perform going forward. So you need expected equity returns, expected bond returns, volatility of equities, volatility of bonds, the correlation between equities and bonds. And we use those to generate kind of forward-looking Monte Carlo scenarios. So at least 5,000 different potential paths of the market. From there, we can look at different demographic assumptions and portfolio assumptions. So we could look at a 55-year-old that wants to retire at age 60, or a 60-year-old looking to retire at age 70. They can have different account values, initial starting portfolio values. They can have different asset allocations between a more aggressive 80% equity, 20% bond type portfolio, or a 40% equity and 60% bond type portfolio. And we can put all these different assumptions in and see how each one of those spending plans might work, at a legacy age of, like as Greg mentioned, age 90 or age 95. So in order to then do that, we need to have some kind of metric of success, some metric that defines success. And we really looked at kind of two separate things here. First being lifestyle. So how much income can be produced by the current portfolio under those certain assumptions at that asset allocation, as well as a legacy value. Is there some amount that the client wants to leave to their heirs or to a charity at a certain age, say 90 or 95 again? So in order to be successful, we are going to look at having each potential path of the market has to fulfill the income needs of the client as well as the legacy needs of the client. From there, we just run the portfolio through each of the 5,000 scenarios. And if the legacy goal and the lifestyle goals are met, we determine that scenario being successful, and we would come up with what percentage of those 5,000 scenarios are successful to get a probability of success type measure.
So in the paper, you talk about a best case client, and care to walk us through the analysis that was done?
Yeah, so we look at kind of a base case. We started off with a 55-year-old client that was hoping to retire today with a $3 million portfolio with $3 million portfolio and a 60% equity, 40% bond portfolio. And then they want to withdraw 4% from that portfolio starting immediately. And they want that 4% income goal to increase by 2% per year with inflation. So again, we've kind of set this up, this base case. And from here, we can now adjust the factors that we can control. And we identified the four kind of main things that an advisor and a client have some control over, as being the age at which the client retires. So obviously, if you can delay your retirement a little bit, you should be able to increase your probability of success. The contributions to the account, to the portfolio, will obviously impact probability of success. The more a client can contribute to their retirement portfolio before they begin taking income, that's going to increase the probability of success. The level of income they're going to use once they retire, how much they're going to pull off of their portfolio going forward, will influence their probability of success, as well as the asset allocation. So how heavily invested they are in equities versus bonds, how aggressive or conservative their portfolio is, are the four different metrics then that we look at to kind of evaluate and quantify those different metrics on how much each one of those has an impact on the probability of success from that base case going through to maybe a more refined retirement spending plan.
Right. So what's remarkable in the paper is the degree to which you improve the probability of success with those controllable factors. Just talk for a moment about that.
Yeah. So for example, our base case is a 55-year-old that wanted to retire at age 55. And the probability of success there versus waiting 5 more years. So if you can convince the client to delay their retirement by 5 years, so a 55-year-old going to age 60 at retirement, that improves the probability of success by 22%. So an additional 22% of those 5,000 scenarios were successful in meeting their lifestyle and legacy goals just by only changing the one factor of the retirement age.
And then in terms of aggregating all those factors, it improves to what, 93%? Somewhere around
Correct, yeah. We have 37 percentage point improvement in the probability of success. Yeah, so one, like a 56% probability of success kind of in our base case analysis, all the way up to 93% when you're able to, delay retirement by 5 years, increase some contributions during that 5-year deferral period. If you're able to withdraw a little bit less than the 4% initially assumed withdrawal rate, and then reallocate from a 60-40 portfolio down to a 40-60. Each one of those kind of builds on the probability of success, and the incremental amount ends up being a 37 percentage point increase in probability of success by making tweaks to those 4 controllable factors.
Certainly not an insignificant number. Talk now about the number that is perhaps hard to control, the uncontrollable risks, and how those affect the client's retirement.
Yeah, once you're kind of controlled for the things that you can, I think we like to view it as there are still some risks out there that you cannot control for. Like, you cannot control for longevity. You cannot control for what the equity returns in the market will be going forward. You cannot control for inflation, and you can't control market shocks or a portfolio shock at some point in the future. But we think there are ways you can reduce your exposure to some of those risks. And I'll let Greg maybe walk through how we quantified those risks and maybe one potential solution to mitigate some of those risks as well.
Certainly, yeah. So, longevity just in and of itself, looking at the risk that your client lives past life expectancy and thinking about the planning implications of that, depending on their net worth, you may underplan or overplan. And if you're in a position where you've underspent and they pass away early, they could have lived a different lifestyle. They could have lived and maybe potentially spent more, but who knows? Then there's also the other side of that coin where you're planning and now they are into their 90s, 95 and 100, and that wasn't something that was allocated for. And if you look at just, true liquidity versus technical liquidity, Wade Pfau speaks a lot about this. And he looks at the needs that you need to solve for in retirement and how are they being satisfied by what asset? What is your asset that you're earmarking to fund those liabilities? And his argument is that if you have a portfolio that's technically liquid, allocate 90% of that portfolio for life expectancy expenses, looking at healthcare events, whatever, then it's not really liquid because those are things that need to be subsidized by the portfolio at some point. So keeping in mind things that you could incorporate into a portfolio that maybe free up the liquidity for clients that live longer, having guaranteed lifetime income as an example, frees up the liquidity of the rest of the portfolio, meaning you can use that portfolio for other needs, and it could be discretionary. But if you enter into a situation where, as we examined, you start de-risking a client portfolio, and now you're only holding 40% equities and 60% fixed income, while your probability of success to age 90 is still substantial at 93%, if you live to age 100, it falls to 75%. So there's a major difference just in living an extra 10 years that the portfolio falls off a cliff as far as its ability to fund those expenses that you're going to need to solve for as the clients that you're working with live longer.
And the same holds true for equity risk?
There's also a change. It's not nearly as substantial. So we did examine just a 1% change when it comes to your assumptions for equity market returns. And we looked at a 6% return versus a 7% return. So if the portfolio only generated 6 instead of 7, with the same asset allocation of 40-60, your success or legacy goal, achieving that only will drop to 88%. So before it was 93, now it's 88. So it doesn't sound like a major drop, but if you start to compound that over 1, 2, 3, or 4% difference in return, now you're talking potentially 15 to 20%. And now you're back down into the 70s, which may not be acceptable for most. So that is very substantial when you think about just the derivation of a couple percentage points either way on your capital market assumptions, as far as what your return needs to be to continue to achieve success. And then on the other side of that coin too is just thinking about what could happen when it comes to interest rates rising, and also too shocks within that portfolio, because a lot can happen over 25 or 30 years.
So when you add up all the adverse effects of these uncontrollable risks, what do you learn?
So we've learned that longevity is certainly the most pernicious when it comes to having an impact and really making a difference in what success looks like for your client. That changed the base case by nearly 20%. So that's quite substantial. And thinking about 85 to 100, that's a large variance in life expectancy when you're putting those assumptions into your plan. So keeping that in mind, that has a large impact, and that's clearly out of our control, but you have to be able to account for your clients living well beyond life expectancy, and how does that change their picture. Then there's equity market shock risk. So you look at that same allocated portfolio between 40% equities and 60% fixed income. That was a 15% change. So you took your base from 93 down to 78. That's assuming we had a 30% equity market drop and a 5% drop in the bond market just 5 years into retirement. And so those first 5 years are absolutely critical that you get this right, or at least to the best of your ability, have things in the portfolio to protect against a shock. That causes a large amount of havoc that in a lot of cases it's tough for clients to recover. Then you look at things like inflation, which are becoming more of an issue. If you're checking prices over the last couple of months, I mean, we've seen a change in a lot of just staples. And so inflation risk is real. It's going to continue to be a challenge. And that had a 7% change in our analysis. And we only assumed a 0.5 percentage point increase in their withdrawal difference from the base case. So instead of needing to increase their withdrawals by 2, we looked at saying, what if they need to increase their withdrawals by 2.5? Imagine if you compound that out to a 1% increase or a 3% increase. Now that again drastically changes your percent chance of success. So we've looked at small tweaks within the engine, but also want to help people understand that looking at what those could potentially be, if it's not 0.5%, if it's 1, 2, 3, or 4%, that is extremely pernicious. And then also too, just your return assumptions. If you're within a point or two difference of what you're assuming, that plays itself out over 25 or 30 years. It makes a large difference in what your ending outcome looks like.
So speaking of outcomes, the RMA is all about improving outcomes. It's all about trying to manage and mitigate the risks that you might face in retirement, like longevity and inflation. And it's about using the appropriate risk management techniques to identify which are the most appropriate products and which are the most appropriate accounts to use to create a portfolio for a client that will help them achieve their goals. Talk about how one can improve outcomes in the face of these uncontrollable risks.
Mark, do you want to take it for more of a portfolio and asset liability matching, and I can address more so solutions specifically?
Yeah, so I'll start off and just kind of, you're right, hitting on the RMA. I mean, our research really kind of tried to build that framework to actually evaluate client outcomes and quantify those retirement risks. And now that we've got the framework built around the outcomes and how we can quantify that, now we can strive to find ways to improve those client outcomes and ultimately manage and mitigate those retirement risks. And one of the products that we think that can do some of that is a registered index-linked annuity with the potential for increasing income. It's a product you'll see kind of out in the marketplace now. It's, there's fee-based versions, there's commissionable versions of these products out there. It's not annuitization. This is a guaranteed lifetime income benefit. So you're not handing over money to an insurance company and seeing an account value drop instantaneously. These products have an account value. So if you had $1 million account and you allocate 20 or 30% to the annuity, you still have the $1 million account value the next day. And we've seen that these types of products, the guaranteed lifetime income inside of them, especially if it has the ability to increase, can actually reduce your exposure to those risks that are uncontrollable. The longevity risk is obviously drastically reduced when you can have a product that offers guaranteed lifetime income. Your exposure to inflation risk can be reduced because you've got this potentially increasing income stream coming from the registered index-linked annuity. Your exposure to equity returns can be reduced because you've got some buffer during the accumulation period and some more defined outcomes inside the annuity during the income period. as well as your exposure to shocks can be reduced as well. But I'll let Greg dig a little bit deeper into maybe how some of that works.
Certainly, and some of the things that you're posing to candidates pursuing the RMA and some of the curriculum just around threats to retirement income that aren't present in accumulation, and looking at what's different. And obviously the math is different. And so just having things in place that buffer against the downside, but then ultimately to create an asset that you can draw on that will continue to provide income, even if you exhaust the principal. And so I think ideally we'd like to structure portfolios where clients can live off of principal and they don't have to, live off of the interest and not have to dip into principal, right? I mean, the whole goal is to preserve the principal. And one of the things that Mark and I have found in leveraging annuities with lifetime income benefits versus annuitization as an example, because there's been so much academic research done on annuitization, that there are solutions out there that are available that doesn't require that. And when you look at what that means to a client and to an advisor, it helps them create more efficient retirement income streams. So in a lot of cases, you're able to increase the legacy wealth that a client will have in the future. And we're talking, 20, 25, 30 years in some cases, where you're actually able to grow their net assets over that period of time versus starting to see a declination of assets as their withdrawal rates get much higher. What you're going to be needing later in life with things that can come up, you end up taking a lot more out of the portfolio. So this helps keep that withdrawal rate a lot lower, in some cases less than 4% on aggregate of the whole portfolio, when you have a product that can pay 5, 6, 7%, if not more in some cases, over a client's lifetime. And so while you may exhaust the asset over a period of 25 years, that's perfectly okay, because it should give you the ability to take less off the rest of the portfolio. You're taking pressure off the portfolio, and maybe you invest differently over that horizon. So keeping in mind solutions that are readily available to advisors today, and then to Mark's point, being able to put a framework around how do I model this? How do I actually put this into the context of what I see in the future versus what's happened in the past? And addressing some of those risks that are not present in accumulation. Sequence risk doesn't matter in accumulation if you have a long horizon. You keep investing, you get through it. It's noise on the radar. But when you start to see losses in retirement early on and you're withdrawing, that compounds things. It makes that a lot more difficult to recover from. And inflation becomes more of an issue, keeping purchasing power, and then just sustainability and making sure that not only your clients keep the lifestyle they want, but maybe also to pass on the legacy they desire. And that's one thing Mark and I talk a lot about is lifestyle adjustment. What's your probability of having to adjust? So for some people, it's not that failure is running out of money. That's not reality for them. But failure might be that they can't do the things they are used to doing in their working years. So trying to put, that framework around it so people can evaluate these just like they would other investments.
So it's a good point. I'm often reminded of that there's a gentleman who once said to me that people don't necessarily run out of money like Wile E. Coyote running off a cliff. It's more that they run out of lifestyle, and I think that's the point that I take from what you just said, Greg.
Yeah, I mean, everybody needs cash flow, right? Everybody's got a certain expectation of how they'd like to see things go. And then when things change, we'll often hear people say that guaranteed lifetime income isn't a concern, but it's not necessarily that they need more guaranteed income. It's a matter of cash flow and lifestyle that they want to maintain.
Yeah. So in the study, you looked at the impact of a RILA on the controllable factors. Talk a little bit about what you found there.
Yeah, I can hit on that. We basically we compared our 40% equity, 60% bond portfolio that we ended up with after we made those 4 adjustments to the base case that I think it ended up with a 93% probability of success. And we took that 60% that was allocated to the bonds and we split that in half and kept 30% invested in bonds, and we allocated 30% to the RILA. What we found was that even in the base case scenario, so even if things go according to all the plans that you put in, your capital market assumptions maintain, your inflation assumptions, there are no major risks that you see when you evaluate the portfolio without the annuity, the 40% equity, 60% bond portfolio against the 40% equity, 30% bond, 30% annuity portfolio, you actually see that the probability of success, even if things go according to plan, increases by just allocating that 30% to the annuity. So you can improve be above and beyond your base case by taking 30% of your bond portfolio and allocating it toward the annuity.
And then its impact when you look at uncontrollable risks.
Yeah, it definitely has a mitigating factor on those uncontrollable risks. So again, in our base case, when you change that life expectancy or the terminal age from age 90 to age 100, you saw that 93% probability of success drop by 15 percentage points. When you have the annuity in the portfolio, the 40, 30, 30 instead, that probability of success, I don't have it right in front of me, but I think it's 5 or 6% drop as opposed to the 15%. So yep. Significantly less exposure to that market risk, that longevity risk. It was dropped 18% without the annuity and 5% when you include the RILA into the portfolio. And similar reduction in your exposure to the equity risks, the inflation risk, and the shock risk. I think all of them, it reduced the equity risk and the inflation risk reduced by at least 2 to 3 percentage points. The amount you're exposed to those risks, and then the shock risk, it actually reduced by almost 10 percentage points, 9 percentage points of reduction to that risk.
Greg, you were about to add something?
Yeah, I was going to say, it takes you to single digits, right, as far as your exposure and the magnitude of those risks. And if you think about having a baseline of 93%, and you may stop there and say, that's perfectly acceptable, we're going to be fine. Dig deeper, and maybe going from 93 to 96 in this example doesn't seem like it's super meaningful. But then when you cut that to a much shorter risk when it comes to longevity, equity, inflation, and shock risk, and now you peel back the onion and you see, okay, well, these things could present a challenge if something happens, right? That's the scenario testing. So on the face, it doesn't seem like there's a real need to dig deeper. It seems like things are going to be fine. The percentage chance of success is really high. It could still go up, and that's a good thing, but also too, uncovering some of those things that are hiding, that are high impact, but low probability risks. And that's one of the things that, whether it's a modeling engine like this or within the financial planning software through scenario testing, is critical, is trying to identify those high impact, but low probability risks that are hiding in a portfolio. And those are often things that are on clients' mind that they don't know how to bring up. Everybody still goes back to 2008. There's still pain there. And I think that's still in the back of people's minds is, well, what happens if, right? What happens if this occurs? And so being able to go through that scenario testing and vet something, and then also look at it within the context of a plan, is really valuable to know, as a client, that my advisor's done the due diligence and said, hey, even if this happens, we're still going to be successful. Just adds another layer of peace of mind into conversations for clients when you're starting to talk about retirement.
Talk more about there's the research, and then there's the tool that advisors can implement in their practice with their own clients. Talk more about that.
Yeah, Mark, you want to start?
Yeah. So kind of going back to our original hypothesis around this, the original impetus for building this tool in the first place was we didn't want to be telling people, hey, this is the Allianz view of the world. This is how we implement things, and this is why it works well in this specific scenario. We realize that advisors and their clients have their own view of the world, their own capital market assumptions, their own specific needs around income and account values and demographics. All of those types of inputs, we built this impact report tool to take those in as inputs, and doesn't have to be the Allianz view. It can be a different set of capital market assumptions you can find on the web, or a customized set of capital market assumptions. We've got the ability to allocate to 3 or 4 different asset classes. We realize that some people might be like to analyze a little bit more in depth than just equities versus bonds. So we can add in global equities, U.S. equities, emerging market equities, et cetera. We can also again analyze these things from a different demographic perspective, different portfolio levels, different ages. All these different assumptions going into the tool will produce different outcomes. And to the extent certain clients or situations, it might be more or less beneficial to implement a registered index-linked annuity into those portfolios. We can look at allocating just 10% of a client's assets to it, or up to 40 or 50% of a client's assets into the registered index-linked annuity with guaranteed lifetime income. So we wanted to build this kind of agnostic and really allow access to it, so that investment committees, advisor groups, registered investment advisors, they all can perform their own analysis and really understand the implications that that their decisions have on the controllable risks, as well as their assumptions that they're putting into some of the uncontrollable risks.
I'll just add one additional thing. I mean, the analogy I draw to is Aladdin. I think from the asset management side, BlackRock's done a great job of providing analysis where you can input a portfolio, get a better understanding of risks when you look at exposure to certain sectors or what you're owning, maybe there's overlap, et cetera. And so at a very baseline, we wanted to give advisors a way to test their capital market assumptions, their portfolio allocations against certain drawdown strategies and see what is your baseline level of success before you go into a full financial plan and see, okay, if I add in Social Security and everything else, how will the portfolio fare by itself? And then looking at, if I were to add in an annuity with lifetime income, are there benefits to doing so? And it's also really helpful for people to understand, well, how much is the right amount? That's a question we get often is, what is a proper allocation? What's enough to make this meaningful? What's not enough? And so we feel a lot better about helping people understand how much is an appropriate amount, and then from what asset class, and knowing that you've got assumptions for returns for equities and bonds, and then knowing what the annuity can provide from a return and risk perspective, then it helps you better understand which asset class is appropriate to reallocate from. So that way you're also still maximizing your risk-adjusted return with the portfolio and then still meeting the income needs.
Yeah. So where can advisors learn more about the tool and how to use it?
So we are in the process of making this more widely available to advisors now. I know that the tool was just added to our website, and the plan, Mark, correct me if I'm wrong, is to be able to allow people to run their own analysis over the next 6 to 12 months. We'd like to have that capability available.
We're working towards that capability, exactly. Yeah, right now, it's a select group of Greg and his team, essentially, that can demo this. Eventually, we'd like to roll it out further than that.
Yep. So our team specifically has the ability to run it. So it's our RIA Institutional Markets team, and that's something that you can request, whether it's on our website or send us an email, and that can be something we can produce and customize to any firm. So right now, it's more of a pull as far as requesting, but our hope in the future is that it can be more widely accessible to investment advisors to play around with on their own.
So as the editor of the Retirement Management Journal, I'm always eager to learn what's next in terms of the research. Are there some unanswered questions or some things that you would like to further explore and write about, given what you've discovered in this paper?
Yeah, I think one of the biggest things that we see here is that, probability of success, the way we're defining it is very kind of rigid. It's very deterministic. We're pulling a specific amount of income out every year, increasing that with inflation. And if the portfolio starts to go down, we're not adjusting our retirement spending plan right now. We're not adjusting our income needs. In reality, if a client realizes that their probability of success is decreasing because their account value is going down faster than they thought it would, they're going to change their behavior. They're going to adjust their lifestyle and withdraw less income from that portfolio. So one of the next steps we'd like to get to in the near future would be adding in some kind of a dynamic withdrawal strategy. So as the portfolio grows in value, maybe the client is able to take out more income and improve their lifestyle. As their portfolio decreases in value and their probability of success is going down, they would probably adjust and reduce their lifestyle expectations and withdraw less income from the portfolio to bring their probability of success back up. Now, it's a really difficult mathematical problem. It becomes what we call a nested stochastic. It's random on top of random. So it becomes the 5,000 scenarios becomes 25 million scenarios very quickly. And we're not there yet, but we're in the process of trying to create a framework to add that type of analysis into this and really kind of come up with some dynamic withdrawal strategies and the ability to quantify the impact those withdrawal strategies will have on the probability of success.
So, Greg, I know I should have mentioned earlier on that that some of this work was influenced by Jim Sandich, whose papers we've published in the Retirement Management Journal. Just talk for a moment about the influence that Jim has had on your work here and the work that you might be doing going forward.
Yeah, I would say a lot of what we've built into the modeling engine, having read his paper, Chaos and Retirement Income, even going back to adaptive distribution theory and looking at the math and how it's different, it's almost so obvious that I think a lot of people ignore it and don't dig deeper to understand the implications of things like that, even small losses early on. So for me, that was a big catalyst in what can we do to bring this to life and have more of an interactive experience for advisors to go through and do the scenario testing. And then the last paper he came out with, Odds Are Retirees Don't Care About the Odds, was very interesting in going at Monte Carlo analysis. And the broader point being dig deeper. And so while we all kind of align around this terminology or this percent chance of success, since the headline of every single financial plan, it's also worth going through scenario testing, whether it's the What If Worksheet in Money Guide Pro or the Decision Center in eMoney, going through and doing that due diligence. Not that you need to go super detailed with clients, because we have a hard time processing probabilities, which I think was also a really good reminder from Jim's research and how to communicate to clients, keeping it simple, but also showing them that you've done the analysis and saying, okay, so if this happens, this is what the implication is. And so that was all really good for us to keep in mind as we present data and how we can make this detailed enough for somebody who's very analytical to feel like it's accomplishing what they're trying to accomplish by way of providing that level of analysis, but also two, helping them get a high level understanding of where solutions can fit and make a difference. So for me, that was really helpful to have that as kind of a guiding light for this is some of the things that we want to be able to demonstrate in our tool. And then also, hey, here's how we should think about speaking to advisors about it. So for me, that was really helpful just as a baseline to make sure we're incorporating some of those thoughts and then continuing to tell the story that Jim had built out in his papers.
So we've covered a lot of ground. Is there anything that we haven't touched upon that is worth mentioning, or anything that we've already touched upon that bears reemphasizing?
I'm not sure that we can cover everything in an hour, but I think that you've done a pretty good job, Bob, of asking us pointed questions. For Mark and I, really trying to remove stigmas around what annuities are and what they're not, and just focusing more on what they provide in the way of guaranteed lifetime income, and trying to give advisors ways to quantify the value of that is what we strive to do. If I were to leave everyone on this discussion with that, is just thinking more so about how to incorporate lifetime income, whatever that looks like. How can that have an impact within your client's retirement, within your financial plan, and think of it that way, not necessarily a packaged product that may or may not have positive or negative connotations along with it.
Well, I think it certainly fits in nicely with the RMA, that message, because in the RMA program, we think about matching, among other things, guaranteed sources of income against your essential expenses as just the basis for creating a floor for a client, and knowing that that floor will help them cover their living expenses over the course of their lifetime is a really important component of the RMA. So, Mark, Greg, I want to thank you both for joining us on the podcast today. I'm sure our listeners will benefit greatly from listening to it.
Thank you, Bob.
Yep, our pleasure.
Thank you for listening. To learn more or to compare potential outcomes between RILAs and other potential retirement solutions, reach out to your Allianz sales contact. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.